I would be hundreds of thousands of dollars wealthier if my parents had avoided this simple but very common investing mistake. This video will help you avoid it. Let's start with a simple question. Would you rather have $10 or $12? I'm sure you'd all say 12. But what if I told you that when the question is presented differently, most people actually choose 10 without even realizing it? This is due to a concept called loss aversion, which is one of the main ways our brains trick us into making bad investment decisions. And it usually costs us a lot more than $2. The concept of loss aversion was developed by Nobel Prize winning economist Daniel Kahneman and Amos Tversky. And today, I'm going to explain what it is, how it leads us to make bad investment decisions, and how you can overcome it. By the way, if you're new here, I'm Ethan with Fundamentals of Finance. I'm a CFA charter holder and investment professional, and this is part of our series on the psychology of money, which will help you develop the mindset that sets great investors apart from the other 99%. At a high level, there's perhaps no better explanation of loss aversion than the one that Brad Pitt gave when he was playing Billy Bean in the movie Moneyball.
And I hate losing, Choppy. I hate it. I hate losing more than I even want to win.
Statistically, people hate losses about twice as much as they enjoy gains of the same amount. Benjamin Franklin was right when he said that a penny saved is a penny earned. Or, put differently, if you avoid losing a penny, that's the same impact on your finances as if you make a penny. But our minds trick us into thinking that these things are very different. For example, when people are asked if they'd like to flip a coin where they can either win $15 or lose $10, lots of people choose not to play. Mathematically, of course, you should play. That's basically how casinos in Vegas make their money, by making small gambles over and over where the odds are slightly in their favor. But our brains hate the potential to lose money so much that we often decide not to play, even when the odds are in our favor. Here's a real-life example. In 2017, NYU economics professor Tatiana Hamana did a study where she compared the effects of a 5-cent tax for using a plastic bag versus a 5-cent reward for not using a plastic bag. These are the same things, right? Well, not in our minds. The 5-cent reward didn't do much. It's 5 cents. Who cares, right? But we hate losing so much that a 5-cent tax caused people to reduce plastic bag use by 42%. Here we're talking about 5 cents. But have you ever thought about what this can do to your long-term investment returns? The price tag could be in the millions of dollars, not cents. The main way loss aversion impacts our investment decisions is that it makes us risk averse when we have gains, meaning we sell our gains too early to get a guaranteed win, and it makes us risk seeking when we have losses, meaning we often will take even more risk when we're down to avoid realizing a loss, which often leads to way bigger losses. That's one of the ways that loss aversion, the strong desire to avoid losses, can eventually lead to even bigger losses. Since I mentioned Vegas casinos earlier, let's start here for the most obvious case. This is how gambling addictions bankrupt people, even when they're multimillionaires. They just hate losing so much that they bet more and more and more to try to get out of the hole. And they end up digging themselves into an even deeper hole. Professional golfer John Daly lost over $55 million gambling from 1991 to 2007, which was way more than he actually made on the PGA Tour. He also took some serious gambles when picking out his pants, and I'm not sure if those paid off either. But I digress. It's not just about gambling. When it comes to investing, loss aversion can also cost you millions of dollars. To see how, let's consider a study that economist Terence O'Dean did to show how loss aversion works out in the stock market. He looked at the trading records of 10,000 investors at a major brokerage firm over a period of 7 years. No surprise, he found that they were quick to sell winners and they held on to their losers too long. But here's why that's such a big problem. Because when you compared the average returns on the stocks that people had sold versus the returns on the stocks people had bought, over the next year, the winners they sold out of beat the losers they held on to by about 3.5% on average. How much does 3.5% equate to? Well, it depends on how much you invest and for how long, but for some simple rough math, on a $100,000 investment over 30 years, the difference between a 10% return and a 6.5% return would be about $1.1 million, 11 times your initial investment. It could literally cost you millions. The other way loss aversion can cost you millions is by causing you to be too conservative with your investments earlier in life. Keeping a big portion of investments in cash or bonds can cost you more than 3.5% per year over your lifetime. At the extreme, when the fear of losing money causes people to avoid investing at all, loss aversion can literally be the difference between your dream retirement and not being able to retire at all. This was basically what my parents did. My great grandma left me a little money when I was a young kid, which I didn't know about until I was in my 30s. While I was still happy to have it, it would have been worth about 20 times as much as it was if my parents hadn't put it all in a savings account for fear of losing money. Basically, any investment, any broad mutual fund would have done significantly better. I can't fault them though. They don't have an investment background, and investing is scary. It's uncertain. It's counterintuitive. It doesn't make sense when you think about it the same way that you think about everything else in life. Sometimes trying to avoid risk can actually lead to taking more risk, or sometimes trying to avoid losses can actually lead to even bigger losses. So here's how you can overcome loss aversion and make sure that doesn't happen to you. Let's first start with the extreme example and work our way down from there. Two absolutely crucial things to know about investing that few investors know about are: one, the stock market cannot go to zero and pretty much can't even go down in the long run, outside of some fringe scenario like a zombie apocalypse. The stock market is just basically all the major companies in the US, or maybe even the world, depending on what index you buy. In order for the stock market to go to zero, all the companies would have to go to zero. That means we're basically back on the barter system. Not a likely outcome. And if we do have a zombie apocalypse or a nuclear world war or something like that, we probably have bigger problems than the value of our investments. Over a short period of time, like a month or a year, the stock market can absolutely lose money. Individual stocks can also absolutely go to zero. But over a long period of time, with a broadly diversified mutual fund or ETF, you are actually taking more risk by not investing. Risk is not the risk of your investment going down. Risk in investing is the risk that you won't achieve your goals. No one invests just for the sake of investing. You're sacrificing current spending for more future spending. You invest for a house or your kid's college or your retirement. It's so you'll have money for something you'll want or need in the future. With a short term goal, the stock market is really risky because it's unpredictable in the short term. But with a long term goal, not investing is riskier because the odds of not meeting your long term goals are way higher if you don't invest in the stock market. Let me give you some numbers to back this up. Over the last 50 years, the odds of losing money in the S&P 500 over a month was 36%. It's unpredictable. In a year, it was 18%. Slightly better, but still probably too high to risk your money if you're investing for a short-term goal, like buying a house in 1 year. But the longer you invest for, the lower your odds are of losing money. Over 20 and 30-year periods, you actually never lost money at any point in the last 50 years. In fact, the worst you ever could have done over a 20-year period was a 4.8% annual return, or 2.5 times your money over a 20-year period. And the worst you could have ever done over any 30-year period was a 9.3% annualized return on your money, or 14x growth over 30 years. That's the worst. Could it do worse than that? Sure. But if the worst it did over the last 50 years was 14 times your money in a 30-year period, what do you think the odds are that it goes down over the next 30-year period? Not very high. Hopefully, knowing these things, one, that the stock market is incredibly unlikely to go down over a long period of time, and two, that the real risk in investing is not meeting your goals, will help you overcome the fear of investing for your long term goals. Now, for those who are more comfortable with investing and want to try to generate better results, here's how you can overcome the negative impacts of loss aversion that convince you to sell winners too soon and hold losers too long. It starts with your initial mindset. Investing is risky, and you will not always be right. It's part of the game. The most successful investors of all time are only right like 55% of the time. You have to learn to accept losses, or you will not be able to be a successful investor. Next, it's crucial to make sure that you always look forward and ignore the past. It's hard to drive forward while looking in the rearview mirror. it doesn't matter if you have a gain or loss, other than for tax purposes. And for that, you'd actually want to sell your losses and keep your gains, the opposite of what loss aversion usually makes people do. But other than selling to reduce your taxes, buy and sell decisions should always be made only looking forward. I'd encourage you to check out our anchoring video if you haven't seen it yet. But a point from that video that I'll reiterate here is that the price that an investment used to be is totally irrelevant. Everything that will affect its future price will happen in the future. Just because something is up or down a lot doesn't mean anything about its future direction. That can certainly be a starting point for doing more analysis, but ultimately, things usually go up or down for a reason. So you have to assess whether that reason was justified or not. If it went too far, maybe it's poised for a reversal. If it didn't go far enough, then the recent trend up or down could continue. All that matters is what will happen in the future versus what is priced in currently. The best way to avoid loss aversion is to remind yourself of that fact and then reassess your portfolio regularly with fresh eyes. If I were to build this portfolio from scratch today, is this how I would build it? If so, don't do anything, even if you've got a big loss or a big gain. If not, that's a sign that you might want to make a change to get it back in line with your current convictions. If you found this video helpful, please do us a solid and hit the like and subscribe buttons and stick around for the rest of the series on the psychology of money. And if you'd like to interact directly with my business partner, Kyle, and I, along with a whole community of investors just like you, check out the link in the description and join our free Discord. We'll look forward to seeing you in the next video.